comes to investing, products in equity and debt, gold are largely known to investors. But there's one category that is lesser discussed, and in fact, more than one. We're talking about REITs, InvITs, and alternative investment funds. On the Money Show today, we will shed more light on these investment products. And with me today is Alok Saigal, President and Head Nuvama Private. Alok, good evening and welcome to the Money Show. We are talking about very innovative investment categories which not only provide the benefit of diversification to your portfolio, but also if you are an investor who's got a core and a fundamental portfolio laid down, you can definitely look at these investment products. So Alok, let's begin with REITs because we will not club these investment instruments. Talking about REITs, I think we have 4 to 5 REITs listed in the country. So far, what has been the response and what's the nature and the feature of this investment product? If I could just start with a very basic question.
Sure. Thank you. Firstly, thank you for having me on the show. So I'll give a quick brief on what you asked. So REIT is basically a real estate investment trust. And, this is giving retail investors and obviously HNIs and ultra HNIs access to, commercial real estate in a manner that they don't need to own the property, but they can get returns from commercial real estate. The nature of income, basically any commercial real estate property in India is then leased out to, grade A lessors. And these are all rent generating assets. But the end investor basically gets distribution in its hand, also in the term of, a dividend and an interest income that these REITs are generating. So basically, these are pooled vehicles which are ultimately buying out grade A real estate assets. So this is a fairly, basic answer to, the question.
What kind of assets do actually REITs invest into? Are we talking about residential property? We are talking about commercial property?
So in India, so far, we have 4 to 5 real estate investment trusts, and all of them so far have all been on commercial real estate. So if you see, there is an Embassy Real Estate Trust, which is earlier it was the Embassy Group and Blackstone, which launched this trust. And now there are other private equity funds also owning it along with the Embassy Group. This is largely commercial real estate. Again, the second one was Mindspace, which is, there are private equity, but again, it is promoted by the Raheja Group. Again, it's a commercial real estate. And the third one also is all on commercial. So currently, all the REITs that have come out in India are largely on commercial. We have one trust which has come out recently, which is a Nexus Select Mall Trust. That is, a trust which has come out for retail assets, which are the mall assets. And they have a portfolio of mall assets. But currently, there is no residential trust in India. Offshore, globally, if you see, REIT is a very, very large asset class. And there we see a mix of, commercial, mixed use, residential, etc. India is evolving, and India has seen rapid development of this asset class. And I am very confident, and we are very confident that over the next few years, this will actually we will see more development and growth of this segment so far.
So the asset class, no doubt, has a promising future, especially if you're using it for diversification. But then this route of investment in this asset class is still not known very much. What do you have to say? Why hasn't it really picked up since the time REIT has been announced as an investment product? So far, when it comes to the understanding of the product, and also, is it something that retail also can participate, or is it just an HNI restricted investment product?
So it is traded. So I'll answer the second part first. Sure, it's traded and listed on the exchanges. So it is, the unit value is, they starts with, 100 rupees, 200 rupees, 300 rupees, depending on the net asset value, like a mutual fund. So retail can participate. It's freely tradable on the exchange. But you are very right. Somehow this asset class has been more popular right now with, the HNI and ultra HNI community, and not so much with retail. So I think the reason for that is that the underlying yield on these assets has to be seen like a AAA fixed income asset. So the underlying yield on the REITs is between 6 to 7%. and the post-tax, because it's a combination of dividend and interest income, the post-tax yield is coming between around 590, in some cases 580, 590 to 6%. Now that may be for retail, and especially people in the lower tax brackets, there may be other options also available which give them a similar post-tax yield. And the second is that using to buy this product, obviously you need to go through a broker, or you have to go through the exchange. So you need to have a demat account and a broking account. So that is the second reason. My thing is that the first reason may be more prevalent, that the fact that the post-tax yields are still lower for the retail investors. But when you look at the HNI investor, he is in the highest tax bracket. For him, a 6% post-tax yield is actually a very, very good. It's like a 10% pre-tax. So I think it's from a segment point of view, that is a reason. But I definitely feel that this is an asset class which will get more popular.
Minimum amount of investment required in a REIT? Alok?
Sorry, I didn't
What
get
is
that.
the minimum amount of investment?
So if you are doing the publicly traded REIT post-listing, you can buy one unit, which is, so if you buy an embassy today, it's 300 rupees per unit. It's like buying a share. You can buy one share of the REIT. If you're looking at the private REITs, or which are not listed on the exchange, they have a minimum cap of 2 crores. So they have a gating of 2 crores for that. But for the publicly listed, the retail, anybody can buy. It's the minimum unit. It's like you're buying a share. So you can just buy one unit. So that is not a challenge.
All right, let's move on to the other investment product, which is InvITs. And how different is it from REITs, and what would be the product feature?
So India as a economy, or India as a country, has actually bifurcated two different asset classes. So REIT is largely the real estate investment trust, and InvIT is a specialized vehicle which invests in infrastructure assets. So globally, if you see, it is one asset class, and product-wise, there is no actual difference in the features. India as a country has actually done a specialization of InvITs. Today, India has more InvITs than REITs. So you have 5 REITs and maybe 20 InvITs that are there in India. And these are, very popular, from public sector units to, some road-based assets, toll-based assets to, other infra assets. So largely, these are either transmission assets, public sector assets, or these could also be road-based assets. This is specifically been, a more popular category because a lot more, assets have been made available, and government has also used this as a tool for, divestment or raising funds. We have seen NHAI raising, an InvIT. Power Grid has done an InvIT for their transmission assets. So it's also good monetization tools. So from a state of the economy where India is, this is possibly both. It allows people to participate in yielding assets, but it also gives government and, it's a good road for funding for infrastructure assets. And that is actually one big difference. That's specifically for infra. Secondly, again, the nature of underlying asset is different. These are more long term. So a commercial asset is, from day one, it is yielding. Similarly, a transmission line, when it's built up, it will yield an annuity. So from the underlying nature of income, they're very similar. But the technical classification of income may be slightly different. In one case, there may be more dividend coming or interest income coming. In infra assets, again, the classification may be different, but fundamentally, they're the same. There is not much difference between the two assets.
Retail as well as HNI can invest in it?
It's the same. So it is the same. Okay. Retail and HNI, same privately held InvITs. It's a 2 crore criteria, and the publicly listed, like a Power Grid, is trading around 117, 118. So you can buy one unit for that. So it's the same, actually. There is no difference from that point of view.
Even the taxation is the same?
Taxation is again similar. Okay. So the taxation, Kavita, is actually done in 3 formats. So there is an interest income that is at the maximum marginal rate of the individual, or whoever, whatever the nature of the investor is. The dividend, again dividend has a 2 nuances. So if it is a trust before 2017, the dividend at the old SPV is actually tax-free at the hands of the investor. The dividend is taxed at the hands of the trust. If it is a new trust, which some of these are, then the dividend is also computed at the hands of the investor. And then there is a capital return criteria, which is computed as a capital gain minusing the cost of capital. But the taxation fundamentally is actually similar for both of them.
Let's move on to alternative funds, and this is one category that's gaining traction, and we're also seeing the regulator coming up with newer guidelines to make it more investor friendly. So in terms of guidelines, what's new, what's changed, and how has it become investor friendly, and who can invest?
So I'll start with who can invest. So the AIFs have a gating of by the regulator of minimum 1 CR. So therefore, they have tried to put that, it's a slightly sophisticated investor. So the minimum gating is 1 CR for AIFs. The second difference is that a lot of space has been vacated in asset classes like, credit by mutual funds and in some cases even by NBFCs. So we are seeing that specialized funds have got created for, participating in credit opportunities, in venture capital, distress opportunities, and various types of AIFs have come in. So these are a lot more specialized opportunities that sophisticated investors can actually participate in. And I think that is where there is a big difference and there is a big growth of this category. So today, the AIF category in India for Cat 1 and Cat 2 has crossed almost 7 lakh crores, which is, has been seen a growth of at least, if not more, a 10 times growth in the last 6 to 7 years, which is a significant growth. This category has also become very popular for people who are, chasing yield. And I think that is where the fundamental interest in this category lies. So people who are looking at, higher yield earlier were, going to mutual funds, etc. But that category in mutual funds, especially after the taxation, has completely changed. So therefore, there is a clear benefit of this category. The other question that Kavita you asked was on what has changed. So there are 2-3 changes that have happened. One, SEBI has introduced a direct category like a mutual fund and a PMS. So they have introduced a direct code or a direct plan in AIFs. So that is one change that has happened. Second, they have also made the payment to distributors. So there are 3 categories of fund: Cat 1, Cat 2, and Cat 3. Cat 3 are specifically equity managed accounts, etc., more like hedge funds, etc., and long only equity fund. So there they have said it has to be an all trail model like a mutual fund or a PMS. So that is so they've made it on par. They made all the 3 categories on par, and I think it's a very, very good step. For Cat 1 and Cat 2, what they have said is any distribution commission that is there, a part of it, roughly 1/3, can be paid upfront, and the rest has to be paid as trail over the life of the fund. So that is because earlier these category of products had a higher, commission or paid upfront. But there's one big fundamental difference which investors should know, that in Cat 1 and Cat 2, the asset management company is paying the commission rather than, the investor, which is very unlike a PMS or a mutual fund, because there are differential fee categories between direct and, the broker code. So here that difference or a nuance is there. And this is a long-term product. So these are almost 10-year products. The distributor also has, or the advisor has to do a fair amount of work, in getting the drawdowns, because these are all drawdown-based products, to get the drawdowns from the investors, etc. So it's, I think, a win-win. And this will further strengthen the industry, in my view.
All right, I think my time is up, and we've got a basic structure of these 3 investment products. I'm sure a longer discussion is needed for this, but then that will be for later. Alok, thank you so much for being on the show today, helping our viewers with these very innovative investment products.
Thank you, Kavita. My pleasure.
Thank you. And on that note, we'll take a quick break. Post that, let's talk about Tata India Pharma and Healthcare Fund. We'll be joined by the fund manager, Meeta Shetty, to answer all of your questions and also understand the fund's trajectory in the quarters coming ahead after this break. Welcome back. You're watching The Money Show with me, Kavita Thapliyal. And on The Money Show, we make sure that we don't just talk about investing in mutual funds, but we also help you meet the brains behind these funds. And in this week's Meet Your Fund Manager segment, we have on board Meeta Shetty, Fund Manager, Tata Mutual Fund. She is the Fund Manager of Tata India Pharma and Healthcare Fund. And let's welcome on board and understand what the fund planning is. Meeta, good evening and welcome to the show. Although you handle more than this fund, but then today let's just talk about this pharma and healthcare fund from Tata Mutual Fund. So before I get into the details of the fund management part, I just want to understand your view on this sector and its trajectory in maybe 2 to 3 quarters from now.
Sure, Kavita. Thank you for having me. If I have to give an outlook on pharma and the fund that I'm taking care of, I'll have to actually split it into two buckets. One would be the pharma and the other would be the healthcare bucket. Now, healthcare bucket categorically has been doing extremely well, especially in the post-COVID quarters and the years after that. And some of it is also driven by the pent-up demand because COVID had some delays and postponement of some surgeries, etc. But even if I have to keep that aside, the sector seems to be growing pretty well and has been showing a good trajectory both in growth as well as on margins. And that's also reflected in the valuations that we are seeing for the healthcare sector. As far as the outlook for healthcare is concerned, the hospital segment continues to remain quite buoyant, and I think that this segment, as far as India is concerned, our penetration levels, our insurance level penetration on the healthcare side, everything is pointing out to a steady growth, not only from 2-3 quarter perspective, from also from a longer term perspective. Whereas the smaller bucket within the healthcare would be diagnostic, which is has been going through a bit of a challenge. It had seen a high base in COVID, and we've seen that the post-COVID years have been quite, taxing for the companies as far as growth is concerned, and even the profitability. There has also been higher competition from the the new age type of companies which have come into this space, which is weighing on the pricing that this industry was enjoying in the previous years. That's a small segment, but that's going through some a bit of a challenge. But overall, healthcare, I would still put it as a pretty strong outlook going into the future. Whereas the pharma bucket, if I have to talk, I think again that would further split into domestic and some export-facing revenue buckets. Domestic has been a very steady market, and it contributes to around 1/3 of the revenues for most top pharma companies, at least I would say. And that's been a very steady growing segment. It's a high cash flow, high margin kind of segment. Whereas the export segment has been seeing a lot of volatility in the past, particularly driven by US, because US takes a larger chunk of that export. And the pricing pressure there has been extremely severe in the past few quarters, and I would say actually since 2015. But particularly last 2 years have been extremely, extremely challenging in that sense. So keeping that in mind, I think when I'm looking at next few quarters to say 2-3 years ahead, it's giving some indication that the pricing pressure, which was very high in the US, is starting to look little better now.
Okay.
I would not say it's a price increase scenario, but the deflation is getting into a better shape. So the outlook is improving, I would say.
All right, let's talk about the fund now. Overall, it's a portfolio of 27-28 funds. What is your market cap exposure across categories?
So if I have to give you a bucket of large, mid, small, the large would be over 50%, so slight skew on the large cap. The rest would be mid and small. But however, how I look at it and how I segregate it in my mind when I'm trying to build a portfolio or change my portfolio, it's more into healthcare and pharma. And if I have to give you that split, on the healthcare side, we used to be at almost 26-27% about 6 months back, where today actually we stand at almost 14 or 15 odd percentage. So we have moved more towards pharma names versus the healthcare names. And clearly the reason is that pharma, as I said, that is starting to look better, especially the export bucket on the US side. Also on the valuations, if I look at the valuations of pharma sector, they are trading at low double digit to mid low teens kind of EV/EBITDA multiples. Even the cash flow yields and the balance sheet, everything is actually looking pretty stable and comforting at this point in time. So I more see it as pharma healthcare bucket, and that's the split as of now.
The general notion for this sector is it's a defensive sector, and people can have people can have it in the portfolio, in terms of stability if that's their target. But when you are investing through a fund and it's a sector fund and has a portfolio of 27, 28 stocks, what is the level of risk that we are talking about for an equity mutual fund investor?
So, Kavita, the sector funds will always come with a higher risk radar because they are very specific to that sector, and sectors do go through their own challenges at times. So that risk is always going to be slightly on the higher side as far as when we are comparing it to the a diversified fund or a category like a PAF. So that's always going to be the case. So the allocations have to be very calculated as far as sector fund is concerned. But when you're betting into these sectors, particularly at a time when the valuations are low and the growth outlook is improving or has been good, that usually gives you also an opportunity to create additional alpha over the broader market returns.
What is the return trajectory that we saw in the past?
So difficult to talk on what returns we can generate, but yeah, I mean, we would also suggest that don't look at the past returns. Look at it more as as an option to take part into the healthcare and the pharma story of the India companies, and the way we have always showcased ourselves as a pharmaceutical industry. Today, we manufacture almost close to $50 billion worth of drugs in India, and half of that actually is exported. Whereas the healthcare, as I said, that we are still sitting at a very low penetration. So definitely the headroom for growth is pretty strong going into next many years. And I think that look at it from that angle rather than looking at or me giving a number that's going to be a little difficult.
Will we be seeing this fund going heavy in mid cap category?
So as I said that we already have almost close to 40+% of mid and small segment. And for me to start positioning accordingly in the stock or any category is more driven by where are the valuations and what is the growth outlook. So if it's falling into a philosophy of say a GARP, which we usually try to follow, then I think that it doesn't matter if it's a large or a mid or a small. If it gives me the option to generate some incremental alpha for the investors, it would be taken in the fund and at the appropriate time and at an appropriate position in terms of the percentage of holding.
All right. Thank you so much, Meeta, for being on the show and helping our viewers understand the pharma and healthcare fund and also plan their strategy accordingly. Thank you so much.
Thank you, Kavita.
On that note, we'll take a quick break, and post that, let's get your portfolio-related questions answered by Feroz Aziz. Welcome back. You're watching The Money Show with me, Kavita Thapliyal, and now it's time to get your portfolio queries answered. And today I have Feroz Aziz, Deputy CEO Anand Rathi Private Wealth with me. Feroz, good evening. But to all the viewers, do send us your portfolio queries on our WhatsApp number, which is 865-797-4571. You can also email us your queries on themoneyshow@etnow.tv. So that's the place where we keep waiting for your questions. Feroz, good evening. Hi, welcome to the show. And I have Prem online with us who wants to ask you his question. Prem from Vijayawada. Hi Prem, good evening. How are you doing today?
Hi Kaushal, thanks for asking. I'm great. How are you? And how are you, Feroz?
Doing good. Thank you so much.
Very good.
All right, Prem. So we have the list of your funds, and you have 10 funds, and you've allocated gold to each funds. What's the corpus that you're looking at?
So it might be overwhelming in the beginning, but this is my dream corpus which I want to create by the time of my retirement. It's 33 years away from my current age. I want to make 100 crore corpus. So I have allocated in a way that in 10 funds equally, irrespective of the category of fund. And 50% of my funds was invested in small caps and 20% in mid caps, and rest is within these three funds. So I want to know whether this is possible with this kind of goal and duration. If it is not possible, then how can I make it possible? Like, should I increase the amount, or should I increase the time duration, or how can I make it work? Like, I want feedback from you.
Sure, Feroz will help you with that. But I really want to congratulate you because you are just 28 years old and you have 32 years to retire, and you've really calculated that very well. Yes, you've got a very aggressive goal, but then nothing is impossible if you start at the right time and you have the right guidance. And today we have Feroz to help you with that. Feroz, will you help Prem become an ultra HNI client of maybe yours?
Sure, Kavita. Good evening, Kavita. And Prem, see, I'm very, very thrilled with your aspiration because everything begins with an aspiration. Ways and means are discovered as life unfolds. You're at the age of 28. Your aspiration is beautiful, point one. Point two, if you've already invested 10 lakhs, I'm sure your disposable incomes have been reasonable and you're not a spendthrift. You've been able to accumulate 10 lakhs and invest it in equity. Point two. Point three, see, creating a large corpus like that, if you work backwards at a rate of interest of 14%, expected rate of interest, of course, 32 years is a long period, but I think because of that period, 14% seems very likely because the next couple of decades, Nifty doing about 10, 11% and active funds giving you that 2-3% extra is not outrageously high. If you work backwards, then a regular investment on a monthly basis, without which this wouldn't be possible, the amount turns out to be 1.28 lakhs a month. Of course, it could be a big stretch at this age, but I'm sure as you progress in your professional journey and put passion there, you will be able to get those corpuses. Now, coming to the portfolio more specifically, one of the fundamental principles you have to keep in mind is don't go for sector funds. So your periods are 32 years, right? Sector funds demand you a great exit as well from you, right? Not just an entry, but an exit is going to be as paramount as the entry would be. Otherwise, over long periods of time, mathematics clearly suggests that you're taking more risk, but the return is actually ending up converging with a diversified equity fund. That's one piece of advice on the portfolio. Second is be very clear on which category you want to invest in. There are about 8-9 categories which are very critical, and don't over invest in one specific category. That's one second piece of advice. Third, of course, the schemes which you have require some mending, in our opinion. Parag Parikh Flexi Cap is skewed towards international investing. I don't think international investing is something which is important at this stage, especially for your retirement corpus. So Parag Parikh Flexi Cap could go out. There are some other schemes which you need to reconsider. Quant Small Cap. Quant is a small fund house. The Quant Active is something which I would vouch for, but you're doubling up your risk because a small asset management company, small cap, it's a little more volatile. So that's one on the anvil. Canara Robeco small cap can be considered to exit. ICICI Technology Fund, which is a sector fund I was referring to. Mira Asset Mid Cap Fund. These are the funds you can consider exiting. The ones which you can include in your portfolio are Franklin Blue Chip, DSP Equity Opportunities Fund, HDFC Flexi Cap, SBI Contra, ICICI Focused Equity, and ICICI Dividend Yield. These are not chosen on the retrospect basis of what past performance they have, but its current constituents and the future potential of each of those constituents are computed, and then we think prospectively these should be good for the next couple of years.
Feroz, Prem needs to increase the investment amount to how much?
See, he has a 10 lakh amount invested, Kavita. So I'm saying that lump sum will not do the trick for him if you have to get to 100 crores. So he has to recurringly, on a monthly basis, invest a lakh and a quarter. Then his goal is possible. Even 100 crores is possible because of his age. 1 lakh a month is what he needs to do. One quarter lakh a month would be needed on a disciplined basis to get to the 100 crore mark.
All right, so that's the recommendation coming for Prem. And Prem, is that anything else you want to ask?
Yes. I'm sorry I missed this point in the beginning. So I have one more thing to say. So apart from this 10 lakh, so I had invested 90 lakh direct equity, which is more or less in momentum shop. So I had subscribed through some advisory and some small cases. So style of investing is almost momentum, most of the portfolios. So eventually all these purpose will go into mutual funds only because I am in a short-term tenure because momentum, I don't know whether it can be working longer or not. So at this point, those are continuing in those. But eventually, I will shift everything
Sure.
towards my board
Okay.
of mutual funds.
Feroz, anything you want to say to that?
Yes, Prem, I think that's a good strategy. Now,
Okay.
if I have to tell you, my portfolio doesn't have stocks in them because the kind of standard deviation, which is the risk measure, it throws up is significantly more. And we have analyzed thousands of direct equity portfolios. The perception of the person who's actually owning that portfolio is far better than the actual reality. If you go transaction by transaction, 92% of the portfolios we have analyzed have underperformed our model portfolio. But if you ask those 92 people on a 100 base, are you doing well? They will always tell you they're doing well because they always look at the best stocks. The worst ones are always held as the tail, which drag the portfolio return if computed on an IRR basis transaction wise. So I would say your odds are better if you implement what you just said, which I think is a great step ahead.
All right, thank you so much, Prem, for sending us your question today. And Feroz, on that note, I'll have to trim our discussion today because we've got some breaking news coming in, the CPI and IIP data. Thank you so much, Feroz, for being on the show today. But then we should focus to the data coming on the economic front. India's CPI for the month of May has come below estimates at 4.25%. Food price inflation has come at 2.9% versus 3.8% in April, while CPI rural inflation has come at 4.17% versus 4.68% in April. Let's welcome on board Saugata Bhattacharya, Chief Economist, Axis Bank, and Madan Sabnis, Chief Economist, Bank of Baroda. Good evening and welcome to the show. Let's talk about CPI, and we also have the IIP data that's come out at 4.2%, which is again a good number. But then CPI, Saugata, it's come down to what, 25-month low? Is that what even you were expecting?
Yes. Hi, Kavita. So we were definitely, our forecast was 4.27%. We just barely missed it. So it's coming in essentially from food prices and a lot of it from some vegetables components. A little bit we had also expected from the miscellaneous component of the core inflation, which is led by gold. But that's a small. What I need to now see is, and this is definitely one of the lower, because I mean this is the base effect. I mean this is a base effect of the May inflation of last year. What we now need to see is the core inflation, which we had forecasted about 5.2. That's not coming off very significantly. So that's a little bit of a worry. But otherwise, inflation is on track to be sub 5% for the next 4 or 5 months at least.
Madan, if I just get you the breakup, cereals up 12.7%, milk up 8.9%, oils down by 16%, vegetables down 8%, spices up 18%, and personal care up 10%. Do you think cereals coming up at around 12.7%, is that a concern? Madan? I think you're on mute. I'm sorry. I think you're on mute.
Sorry. Yeah, I think that is definitely a concern when we're talking of cereals inflation being high, because we had seen that even last year, on account of the wheat crop being affected by extreme heat conditions, we had seen prices going up. Output was also lower. This year, we have seen that even prices of rice has gone up in the market. So both rice and wheat are the pressure points which we're seeing. Add to this the fact that you've not mentioned pulses, but I think in pulses inflation has been over 6%. And this is something which is increasing. So I think when we're talking of El Nino and the possible impact it may have on the Kharif output, where cereals as well as pulses are the ones which are covered, I think that is something which will be of concern both for the government as well as the Reserve Bank of India. Because most of the forecasts of inflation, which appears to be very much on target with what the RBI has forecast for the first quarter being low, will probably happen in case we have a normal monsoon. But any kind of El Nino impact affecting the Kharif crop will definitely have a negative impact. So I think that is something which we need to be watchful of. We've already seen prices like of milk has gone up. Same thing holds for spices. So I think the factors which have been pushing it up remain up. And I think components like edible oils as well as vegetables are the ones which are actually dragging it down. So I think that's something which is probably going to continue. So I think the monsoon will hold the clue for future direction of food inflation.
The monsoon trajectory is definitely a very important trigger, but then I also want to break down, Saugata, the IIP data that's coming in, 4.7% versus 6.7 year on year. Now, mining sector growth is at 5.1%. That's again a year on year number that we are giving you. Manufacturing is at 4.9. Electricity is minus 1.1%. Consumer durable output has come down to minus 3.5. Infra goods output has come at 12.8%. Capital goods has come at 6.2%. How is this data looking as, again, on expected lines, is it?
No, very hard to admit this. We were very wrong. We were about 1.5%. So the extra growth seems to have come in from consumer non-durables, which is the FMCG segment. Most of the others are more or less on track. So this does show that the fears, particularly from the rural segment, of a fairly weak consumption trend in the last couple of months, that now seems not to have actually happened. FMCG sales, which is the consumer non-durables part, besides all the other infrastructure, capital goods, etc., that you're mentioning, those were expected to be robust. Electricity, of course, because of the unseasonal rains in the month of April, we had expected electricity demand to have been weak. But overall, I think this is a fairly good growth inflation mix, that consumer goods demand seems to be relatively strong, relatively resilient, whereas although core inflation is probably still sticky, overall inflation is coming down. So the two paired together paints a fairly good, a comforting picture of the economy.
And do you think, Madan, this comforting picture will be sustaining for a longer period of time? We know that for inflation, monsoon is a very important trigger. But what about the rural demand? And rural inflation also, I think, has come down to 4.17, which is like a very marginal thing. But how do you look at few more quarters, looking at the way monsoon is actually creating issues?
See, as far as inflation is concerned, I think we will continue in this particular direction. So I don't think there's going to be any pressure coming on the inflation front. But I think what we need to be a bit more careful about is how the IIP numbers are going to behave. To my mind, it's happening more on account of a single month impact which is there. There's also a base effect which is involved. Because we should remember one thing, that this is not a time when typically demand picks up. So unlike, I have a slightly different view from Saugata out here, because when I look at the FMCG goods and I see the way in which they have performed, I would rather wait for another couple of months to see if it's actually sustained out there. The same thing holds also for things like capital goods, because we've seen even in the past that in a single month, when we try and interpret the number as being a kind of a recovery, is not really sustained. So ideally, I think we'll have to wait for another 2 months. That is, we'll have to see how the Q1 performance of industry is before we can conclude that something really is happening. Because similar to what Saugata was saying, we were actually looking at an IIP growth number even lower at around 1.2%. So 1.2 coming in now at 4.2 has been definitely a kind of a pleasant surprise. And I would say to an extent it becomes a bit difficult to believe, because with the kind of buoyancy we're seeing in capital goods, we're seeing in FMCG, it's not something which we had actually envisaged. And also, if I look in terms of whether investment is taking place on the private sector's front, not seeing too many signs of it. And it's early days. Investment never really happens in the months of April, May, June. It's more likely to happen post monsoon. So I think the base effects, statistical effects, have been playing a bigger role. So while definitely it's a good sign to say that inflation coming down, growth probably still on target, I would probably wait for another couple of months before I can draw firm conclusions.
Are we on track for RBI's 4% inflation target? Looking at this data, Saugata?
Hi. 4% inflation target for this quarter, you mean?
For RBI, the number that's set by RBI.
Right. So I believe we are, okay. As Madan mentioned. Of course, I mean, there is the risk of an El Nino-induced poor rains, but that will probably show up more towards the end of the quarter. I mean, we have already got the May number. So April and May together combined is about 4.5, let's say. Over that, we probably will get another a number which is close to these numbers. These are preliminary, of course, in the month of June. So we should be on track for an average 4.6% for this quarter. My sense is that overall for the year, of course, this is provided that the rains don't disrupt food prices significantly in this Kharif season. So given that and the fact that we probably are likely to get a cut in petrol, diesel, and other fuel prices somewhere down the line in this year, my sense is that the RBI's 5.1% average forecast for CPI inflation is likely to come in even lower. We are now currently at 4.8. So let's see how this moves up. But together with this, the other fact that we need to be very, very careful about is WPI inflation, inputs costs. Input costs have come down very significantly. We expect WPI inflation to be about 1.5 to 1.6% average for this year. How those input prices are passed on to end consumers will also have a determining factor in how CPI prints begin to shape up over the course of the year.
All right. So, Madan, now what will be the interest rate trajectory for RBI? Do we see a pause being extended further? We have the Fed's interest rate announcements also this week. But then what's the tone for us?
No, I think there will be a prolonged pause. In fact, earlier, before this particular policy, we were thinking that maybe in October or so, there could be a rate cut. But I think going by the commentary, I think it's going to be much later, probably in the fourth quarter, provided the number of 5.1%, which RBI is talking of, takes place. Because if you look at the quarterly forecast, which the RBI has given for inflation, it's actually going to peak at 5.4% in the third quarter. So when inflation number moves from less than 5% to 5.2 to 5.4%, it'll be hard for the RBI to cut interest rates at that point of time. So therefore, I think the earliest will probably be in the fourth quarter, that is in the February policy, if at all the number goes around 5.1. But our forecast is that inflation is more likely to be 5.2, 5.3%. So we are much higher than what Saugata is talking of, because we feel that core inflation is something which is likely to pick up, because we feel that a number of companies are still in the process of passing on the higher input costs. And that is something which will get manifested during the course of the year. So as you mentioned, things like your consumer care, your personal care goods, household goods, they've all been showing high inflation. So I think that is still work in progress. And at some point of time, we will see that show up in the inflation numbers. So anyway, a direct answer to your question, fourth quarter is the earliest when we could see a rate cut, not before that.
All right. Fourth quarter is the earliest we could see a rate cut. Saugata, quickly, your view on the same lines?
I agree with Madan that before the fourth quarter, before the February policy, it's very, very unlikely. In fact, I mean, if you think about it, if the RBI's growth forecast of 6.5 and we are now very close to it at 6.4 average for the year, if that actually happens, if there is really no case for a rate cut. If these strong prints and a sticky core inflation continues for the next few months at least, they will probably not be able to make any significant, meaningful cuts. And remember, this also depends. A rate cut in India also depends, because the differential between the federal funds rate and the RBI repo rate is now very, very small. So unless the Fed begins to start cutting, and markets are already pricing in a much, much weaker set of rate cuts from the Fed, that even RBI will be constrained by how much and when the Fed actually cuts its federal funds rate. So given these conditions, if at all, there will be a shallow 25 basis point rate cut in the fourth quarter in February. But even that it's very, very early to predict at this point in time.
We'll have to see how the events actually shape up. But then so far, it is so far so good. That's a picture looking like inflation cooling down to 25-month low, and factory activity is picking up. Thank you so much, Madan and Saugata, for being on the show and helping our viewers understand this very important data. On that note, it's a wrap. Thank you so much for watching. Goodbye.